Hey everyone, in this video we are going to talk about one of the most basic ideas in trading, but also one of the most important ones. The market is a battle between bulls and bears. Bulls are the side trying to push price higher. Bears are the side trying to push price lower. But I do not want this video to be just a simple definition of bulls and bears. That is not enough. The real question is, when you open a chart, can you tell who is actually in control? Are the bulls controlling the market? Are the bears controlling the market? Or are both sides still fighting, with no clear winner yet? Because in real trading, it is not enough to say, this candle is green, so the market is bullish. Or, this candle is red, so the market is bearish. A green candle does not always mean the bulls are truly strong, and a red candle does not always mean the bears are truly in control. What matters is the story behind the candles. Who is pushing price further? Who is defending their territory? Who is losing strength? Who is failing to continue? And who is taking control of key areas on the chart? So in this video, I want you to stop looking at charts as just green and red candles. Start looking at charts as a battle between bulls and bears. When people first start trading, they usually read the market in a very simple way. They see a green candle, and they think the market is strong. They see a red candle, and they think the market is weak. They see price going up, and they want to buy. They see price going down, and they want to sell. But if you have spent enough time looking at charts, you already know it is not that simple. Sometimes you see a strong green candle, and right after that, price drops hard. Sometimes you see a big red candle, and right after that, price bounces strongly. Sometimes price breaks above a level, looks very bullish, and then immediately fails. Sometimes price breaks below a level, looks very bearish, and then quickly gets bought back up. So the problem is not the candle color. The problem is not whether one candle is green or red. The real question is, who is truly controlling the market right now? Because if you only read candle color, the market can trick you very easily. But if you read the market as a fight between buyers and sellers, between bulls and bears, the chart starts to make more sense. Instead of asking, is this candle green or red? You start asking better questions. Are the bulls actually strong here? Are the bears actually in control? Did the winning side hold their ground? Is the losing side starting to fight back? Is this a clean market, or is this just a messy battle with no clear winner? That is a much more practical way to read price. When I read bulls and bears on a chart, I do not want to make it complicated. You can start with 5 simple questions. Question number 1. Who is pushing price further? Are the bulls pushing price higher with long, clean upward moves? Or are the bears pushing price lower with strong downward moves? Which side is creating the bigger waves? Question number 2. Who is holding their ground better? If the bulls push price up, can they keep price near the highs? Or does price immediately get pushed back down? If the bears push price down, can they keep price near the lows? Or does price immediately get bought back up? Question number 3. How strong is the opposite side's reaction? If the bulls are winning, how strong is the bearish pullback? Is it deep and aggressive? Or is it weak and shallow? If the bears are winning, how strong is the bullish bounce? Is it powerful, or is it weak and quickly sold off? Question number 4. Where is price right now? Is price near an area where bulls won before? Is price near an area where bears won before? Or is price in the middle of a messy range where neither side has a clear advantage? And question number 5. What is the current state of the market? There are only 3 main answers. Bulls are in control. Bears are in control. Or both sides are still fighting, and there is no clear winner yet. If you cannot answer that clearly, the chart is probably not clear enough. And when the chart is not clear, you do not need to force a decision. Remember this. Reading bulls and bears means reading who pushes harder, who holds better, and who reacts weaker. Now let's talk about the first side of the battle. How do we know when the bulls are winning? A lot of beginners think bulls are winning just because there is a green candle. But that is not enough. A green candle only tells you that price closed higher than it opened during that candle. It does not automatically mean the bulls are controlling the whole market. Bulls are really winning when buyers are making clear progress on the chart. The first sign is this: bullish waves are bigger than bearish pullbacks. When bulls are strong, the upward moves are usually longer, cleaner, and more aggressive. The pullbacks are usually shorter and weaker. For example, imagine price pushes up 100 points. Then it pulls back only 30 points. Then it pushes higher again. Who has more control there? Clearly the bulls. The bulls are pushing price further than the bears can push it back. That is the first sign of bullish control. The second sign is higher lows. This is very important in real chart reading. When bears try to push price down, but they cannot bring price back to the previous low, that means selling pressure is not strong enough. The bulls are stepping in earlier. They are buying before price can return to the old low. In simple terms, the bears try to attack, but the bulls defend earlier. And when that happens again and again, the chart starts forming higher lows. That is a sign that bulls are gaining control. The third sign is price breaks above a previous high. When bulls are strong enough to push price above an old high, it means they are not only defending, they are attacking. But there are two types of breakouts. The first one is a weak breakout. Price pokes above the high, but immediately gets pushed back down. That does not show strong bullish control. The second one is a stronger breakout. Price breaks above the high, closes well, stays near the high, and does not immediately fall back into the old area. That is much more meaningful. The fourth sign is bearish pullbacks get absorbed. Absorption means the bears try to sell, but price does not move down very much. On the chart, you may see red candles getting smaller. You may see lower wicks. You may see price moving down slowly. You may see every small dip getting bought back up. That tells you the bears are trying, but they are not creating much damage. The bulls are absorbing the selling pressure. The fifth sign is bulls hold the area they just captured. This is one of the most practical signs. A breakout alone is not enough. The real question is, after price breaks higher, can the bulls defend that new area? For example, price breaks above resistance. Then price pulls back. If price does not fall deeply back below the breakout area and buyers step in again, that shows the bulls are holding their ground. They did not just win one small battle. They captured an area and then they defended it. That is much more useful than just looking at one green candle. So to summarize, bulls are winning when bullish waves are bigger than bearish pullbacks. Bulls are winning when price forms higher lows. Bulls are winning when price breaks highs and holds higher areas. Bulls are winning when bearish pullbacks are weak and get absorbed. And bulls are winning when they can defend the areas they just captured. A strong bull market is not strong because candles are green. It is strong because every time the bears push price down, price gets bought back up at a higher level. Now let's look at the opposite side. How do we know when the bears are winning? Just like before, bears are not winning just because there is a red candle. A red candle only tells you that price closed lower than it opened during that candle. But to say the bears are truly in control, we need to look at the full behavior of price. The first sign is bearish waves are bigger than bullish pullbacks. When bears are strong, the downward moves are usually long, clean, and aggressive. The bounces are usually short, weak, and quickly sold off. For example, imagine the bears push price down 100 points. Then the bulls can only push price back up 30 points. Then price drops again. Who is in control there? Clearly, the bears. The bears are pushing price further than the bulls can push it back. The second sign is lower highs. This is one of the most important signs of bearish control. When bulls try to push price up, but they cannot bring price back to the previous high, that tells us buying pressure is weak. The bears start selling earlier. In simple terms, the bulls try to attack, but the bears defend before price reaches the old high. When this keeps happening, the chart starts forming lower highs. That is a sign that the bears are gaining control. The third sign is price breaks below a previous low. When bears are strong enough to push price below an old low, they are not only defending, they are attacking. But again, not every break is the same. A weak breakdown is when price only pokes below the low, then quickly gets bought back up. That does not show strong bearish control. A stronger breakdown is when price breaks lower, closes low, stays weak, and the bulls cannot quickly recover the lost area. That is more meaningful. The fourth sign is bullish bounces get absorbed. Absorption here means the bulls try to push price up, but price does not move very far. On the chart, you may see green candles getting smaller. You may see upper wicks. You may see price moving up slowly. You may see every bounce getting sold into. That tells you the bulls are trying to fight back, but their reaction is weak. The bears are absorbing the buying pressure. The fifth sign is bears hold the area they just captured. For example, price breaks below support. Then price bounces back to test that area. If price cannot reclaim the broken area and sellers step in again, that shows the bears are defending their new territory. This is very practical, because many beginners sell immediately when they see price break a low. But if they sell too late, they often get caught in a sharp bounce. The better question is, after the breakdown, can the bears hold the lower area? If they can, then we have stronger evidence that bears are actually in control. So to summarize, bears are winning when bearish waves are bigger than bullish pullbacks. Bears are winning when price forms lower highs. Bears are winning when price breaks lows and holds lower areas. Bears are winning when bullish bounces are weak and get absorbed. And bears are winning when they can defend the areas they just captured. A strong bear market is not strong because candles are red. It is strong because every time the bulls push price up, price gets sold back down at a lower level. Now this part is very important. In real trading, it is not enough to know whether bulls or bears are winning right now. You also need to know whether the winning side is still winning strongly or starting to lose strength. Because bulls do not win forever, and bears do not win forever. The market is always changing. One side can be in control, then slowly lose momentum, and then the other side can start fighting back. First, let's talk about bulls getting weaker. Bulls may be getting weaker when price is still moving up, but it is not moving up as well as before. For example, earlier bullish waves were long and strong, but now each new bullish wave is shorter than the one before. Earlier, every breakout above a high led to a strong continuation, but now price breaks above a high and only moves a little bit higher before getting sold down. Earlier, green candles were large and closed near the highs, but now green candles are getting smaller and upper wicks are appearing more often. Earlier, every pullback was shallow, but now bearish pullbacks are getting deeper. These are signs that the bulls may still be winning, but they are winning with less power. Let me be clear, bulls getting weaker does not automatically mean you should sell. It simply means you should stop assuming that the bullish side is as strong as before. Now let's talk about bears getting weaker. Bears may be getting weaker when price is still moving down, but it is not moving down as well as before. For example, earlier bearish waves were long and aggressive, but now each new bearish wave is shorter than the one before. Earlier, every breakdown below a low led to strong continuation, but now price breaks below a low and only moves a little lower before getting bought back up. Earlier, red candles were large and closed near the lows, but now red candles are getting smaller and lower wicks are appearing more often. Earlier, every bounce was weak, but now bullish bounces are getting deeper. These are signs that the bears may still be winning, but selling pressure is weakening. And again, bears getting weaker does not automatically mean you should buy. It simply means you should be more careful if you are still thinking from the short side. In real chart reading, one of the most important changes is when the losing side starts to fight back more strongly. For example, in an uptrend, pullbacks used to be shallow, but now the bears are pushing price down deeper. Red candles are getting stronger. The bulls try to push higher, but they cannot go very far. At that point, you have to ask, are the bulls still in control? Or are the bears starting to take control? On the other side, in a downtrend, bounces used to be weak, but now the bulls are pushing price higher. Green candles are getting stronger. The bears try to push lower, but they cannot go very far. At that point, you have to ask, are the bears still in control? Or are the bulls starting to fight back? Here is the key idea. The winning side is getting weaker when they are still winning, but each win gets smaller. That is how you avoid buying too late at the end of a bullish move. And that is how you avoid selling too late at the end of a bearish move. Now let's talk about price zones. But I want you to think about zones in a practical way. A price zone is not a magic line. A zone is not a place where you automatically buy or sell. A zone is an area where bulls and bears fought before. And in the past, one side won that battle. There are three types of zones we should pay attention to. The first one is an area where bulls won before. This is a place where price moved down, sellers tried to push lower, but then buyers stepped in and pushed price up. From that area, price created a clear upward move. When price comes back to this area, we do not buy immediately, we observe. Do buyers come back? Does price slow down as it moves lower? Do we see lower wicks? Do we see strong buying candles? Can bears break through the area? If price breaks below it, does it get quickly bought back up? The goal is not to guess that the zone will hold. The goal is to see whether bulls can still defend that area. The second type is an area where bears won before. This is a place where price moved up, buyers tried to push higher, but then sellers stepped in and pushed price down. From that area, price created a clear downward move. When price comes back to this area, we do not sell immediately. We observe. Do sellers come back? Does price slow down as it moves higher? Do we see upper wicks? Do we see strong selling candles? Can bulls break through the area? If price breaks above it, does it get quickly pushed back down? Again, the goal is not to guess. The goal is to read the result of the battle at that area. The third type is an area that has been captured. This is very useful in real trading. Imagine there was an area where bears used to win. Every time price reached that area, it got sold down. But this time, the bulls break through that area. Then price comes back to test it. If the bulls can hold that area, the old bear zone may become a new bull zone. In simple terms, the bulls captured the bears' territory. Now imagine the opposite. There was an area where bulls used to win. Every time price moved down into that area, buyers stepped in. But this time, the bears break through it. Then price bounces back to test it. If the bears can hold that area, the old bull zone may become a new bear zone. In simple terms, the bears captured the bulls' territory. When price reaches a battle zone, there are only three possible outcomes you need to watch. 1. The old side defends the zone. 2. The new side captures the zone. 3. Both sides keep fighting, and there is still no clear winner. If there is no clear winner, you do not need to guess. Remember this. A price zone is not an entry signal. A price zone is where you watch bulls and bears fight. Now let's combine everything into three practical market states. State number 1. Bulls are in control. The signs are: bullish waves are bigger than bearish pullbacks. Price forms higher lows. Price breaks highs and holds higher areas. Bearish pullbacks are weak. Every time bears push price down, price gets bought back up. In this state, you do not want to blindly fight against the bulls. You do not want to sell just because price looks high. Instead, you focus on how price reacts during pullbacks. Are the pullbacks weak? Are the bulls defending areas where they won before? Are the bears failing to push price lower? When bulls are in control, pullbacks are often tests of bullish strength. State number 2. Bears are in control. The signs are: bearish waves are bigger than bullish bounces. Price forms lower highs. Price breaks lows and holds lower areas. Bullish bounces are weak. Every time bulls push price up, price gets sold back down. In this state, you do not want to blindly fight against the bears. You do not want to buy just because price looks low. Instead, you focus on how price reacts during bounces. Are the bounces weak? Are the bears defending areas where they won before? Are the bulls failing to push price higher? When bears are in control, bounces are often tests of bearish strength. State number 3. Bulls and bears are still fighting. The signs are: upward and downward waves are similar in size. Highs and lows overlap. Candles have many wicks. Breakouts fail. Breakdowns fail. Price keeps moving back and forth inside a range. This is where many beginners get trapped. They see one green candle and buy. Then price reverses. They see one red candle and sell. Then price reverses again. In this state, your job is not to predict who will win. Your job is to wait until the battle becomes clearer. When bulls and bears are still fighting, do not force yourself to choose a side too early. Now let's walk through a simple chart example in words. Imagine price is moving sideways at first. There are green candles and red candles. Price moves up, then down, then up, then down again. The highs and lows overlap. No side is clearly in control. At this point, we do not say bulls are winning. We do not say bears are winning. The correct reading is, the market is still in a battle zone. There is no clear winner yet. If we choose a side too early here, we can easily get chopped up. Now imagine price starts to form a higher low. The bears try to push price down, but they cannot bring price back to the previous low. Price gets bought earlier. That is the first clue. It tells us the bears are not pushing as effectively as before. But we still do not need to jump to a conclusion too early. We simply notice the bearish attack is weaker. Next, the bulls push price above the top of the sideways range. If price only pokes above the range and immediately falls back, we stay careful. But if price breaks higher, closes well, and stays near the high, that gives us more evidence that bulls are taking control. Now comes the important part. We do not want to chase the breakout blindly. We want to see what happens after the breakout. Price pulls back to the area it just broke. Now we watch the battle. Can the bears push price back into the old range, or is the pullback weak? Do the bulls step in again? Does price hold the area that was just captured? If price pulls back, holds the area, and then buyers step in again, now the story is much clearer. At first, both sides were fighting. Then the bears failed to push price lower. Then bulls created a higher low. Then bulls broke above the range. Then price pulled back. Then bulls defended the area they captured. That is not just one green candle. That is a full sequence showing bulls taking control. Now let's imagine the bearish version. At first, price is moving sideways. Both sides are fighting. Then the bulls try to push price up, but they cannot reach the previous high. Price forms a lower high. That tells us the bullish side is getting weaker. Then the bears push price below the bottom of the range. If price breaks down strongly and stays weak, we now have evidence that bears are taking control. But again, we do not want to chase the breakdown blindly. We wait to see what happens if price bounces back. Price comes back to test the area it just lost. Now we ask, can the bulls reclaim the area? Or is the bounce weak? Do sellers step in again? If price cannot reclaim the broken area and gets sold down again, then the story is clear. At first, both sides were fighting. Then the bulls failed to push higher. Then bears created a lower high. Then bears broke the range. Then price bounced back. Then bears defended the area they captured. That is how you read a chart through the battle between bulls and bears. The key is not one candle. The key is the whole sequence. Who pushed first? Who failed? Who broke the area? Who held the area? Who reacted weaker? That is practical chart reading. Before we finish, let's turn everything into a simple checklist. When you open a chart, ask yourself these questions. Question 1. Which wave is bigger? If bullish waves are bigger, bulls have the advantage. If bearish waves are bigger, bears have the advantage. If both sides are similar, the market is still fighting. Question 2. Who is holding their ground? Do bulls push price up and hold higher areas? Do bears push price down and hold lower areas? Or does price keep breaking and reversing? Question 3. Which side has the structure? Higher highs and higher lows suggest bullish control. Lower highs and lower lows suggest bearish control. Overlapping highs and lows suggest no clear control. Question 4. How strong is the losing side's reaction? If the reaction is weak, the winning side is still healthy. If the reaction is getting stronger, the winning side may be losing strength. If the losing side captures an area back, the balance may be changing. Question 5. Where is price? Is price near an area where bulls won before? Is price near an area where bears won before? Is price testing an area that was recently captured? Or is price in the middle of a messy range? Question 6. What is the current conclusion? Only choose one of 3 answers. Bulls are in control. Bears are in control. or both sides are still fighting. If you cannot answer clearly, the chart is not clear. And if the chart is not clear, do not force a decision. A clear chart should allow you to say who is controlling the market. If you cannot say that, the chart may not be worth forcing. So to summarize, the market is a battle between bulls and bears. But to use this idea in real trading, it is not enough to know that bulls mean buyers and bears mean sellers. You need to learn how to read the battle. Who is pushing price further? Who is holding territory better? Who is reacting weaker? Who is losing strength? Who is capturing key areas? And when are both sides still fighting with no clear winner? One candle can trick you, but the sequence of candles, the waves, the battle zones, and the way price reacts after breaking an area can show you who is really in control. Most beginners ask, will price go up or down? But a better question is, who is controlling the market right now, bulls or bears? When you learn to read charts this way, the market becomes much less confusing. Thanks for watching, and I will see you in the next video.